ways to invest in the stock market. First, pick and invest in stocks which you think will do better than others. Or you can invest in the entire market using the index like Nifty 50 or Sensex. When you pick specific stocks to invest in, you are engaging in something called as active investing. Now, active investing is not a very good way of investing, and it's certainly not for everyone. We will discuss why in a while. And when you don't pick stocks and invest in the stock market as a whole, you are investing passively, which is known as passive investing. Now, passive investing is one of the best ways to invest, especially if you're a new investor. For the longest time now, most investors have been investing actively, and it's not surprising. Everyone wants to find the next multi-bagger, the next HDFC Bank, the next Bajaj Finance. The kick that investors get out of researching and believing that they are going to be right is so strong that they often ignore hard data points and research studies. In fact, there is an entire industry of investment professionals out there who are paid fees to pick stocks only to be beaten by monkeys. Yes, only to be beaten by monkeys. Now, there was an experiment conducted in 1973 in which a Princeton professor claimed that a blindfolded dart-throwing monkey can pick stocks better than professional portfolio managers. In fact, many experiments involving monkeys and chimpanzees and cats have been conducted since then, and our wild and furry animals beat these portfolio managers on most occasions. In fact, a recent study concluded that investment managers who have the popular CFA certification are likely to generate lower returns than investment managers who don't have the certification. And in case you didn't know, the CFA certification is considered the gold standard in the investment management profession. So the moral of the story, stock price movements are random, and it is not possible to consistently pick out the best stocks and generate abnormally high returns. Every year, a SPIVA report is released that compares the performance of active mutual funds to benchmark market indices. Now, here are a couple of interesting data points from the 2021 SPIVA report. 82% large cap funds failed to beat the large cap index S&P BSE 100 over the last 5 years, and almost 70% small and mid cap active mutual funds failed to beat the small and mid cap index S&P 400 BSE index over the last 5 years. This just goes on to show that stock picking, even if done by qualified professionals, does not work over time. You could have simply invested in the index and beaten most of the qualified portfolio managers in the country. Long story short, don't pick stocks or pay someone to do it for you. So I've been saying that you should be investing passively, but how do you actually do that? Well, there are these instruments called as ETFs or exchange traded funds which enable you to invest passively in the stock market. Now, what is an ETF? An ETF is something that basically tracks the broad market index like the Nifty 50. You can buy and sell it whenever you want, and it's also super affordable, so you don't have to pay money to portfolio managers who are busy losing to monkeys. Just by investing in a Nifty 50 ETF, you get exposure to 50 of the largest companies in India just for a few $100. Magical, isn't it? So let's quickly recap this video. Number 1, don't pick stocks yourself. Number 2, don't pay others to pick stocks for you. And number 3, invest in the stock market using exchange trading funds or something which is called as passive investing. And keep going, everyone. You're doing great and just a few minutes away from becoming an investment genius.